Welcome to today's Explainer, where we're diving into what has to be one of the absolute wildest corporate rides in modern tech history. Seriously, we're talking about a company that built the literal, physical backbone of the artificial intelligence boom, became one of the market's biggest winners, and then nearly lost it all. And not just once, but twice. This is the incredible, chaotic story of Supermicro Computer, better known as Supermicro, and it is a complete AI roller coaster. We can no longer rely on management's representations. Now, auditors resign from time to time, right? That happens. But rarely, and I mean rarely, does it happen quite like this. In October 2024, the major accounting firm Ernst & Young filed a resignation letter and publicly wrote those exact words. Just let that sink in for a second. Your auditor, the entity whose literal sole job is to verify your numbers, essentially telling the entire world that they cannot trust a single word you say. Instantly, this statement triggered a massive corporate crisis. So, what does this actually mean on the ground? Well, the immediate fallout was absolutely brutal. That one single sentence from Ernst & Young wiped out roughly 33% of Supermicro's entire market value in a single trading session. A third of the company, completely gone, just evaporated in a matter of hours as investors totally panicked. But to really understand why the market's reaction was so violently negative, we have to realize that this crisis, it didn't just happen in a vacuum. Section 1. The billion-dollar resignation. Because, shockingly, this 2024 collapse wasn't even their first major accounting scandal. Section 2. The need for speed. Let's look at the modular strategy that built them. Let's flash back for a minute to September 1993. An engineer named Charles Liang, his wife Sarah Liu, and their colleague Wally Lau founded a small motherboard shop in San Jose, California. And their defining strategy wasn't to out-invent the massive silicon giants or to outscale the massive contract manufacturers. No, their core strategy was simply speed. Rather than building from scratch, Supermicro used a highly modular approach. Step 1, they'd secure the absolute newest chips hitting the market. Step 2, they'd use modular parts. They basically treated server components like interchangeable Lego building blocks. And step 3, they would reconfigure and ship those servers out the door so much faster than the giant contract manufacturers ever could. And you know what? It worked beautifully. This engineering strategy allowed them to vastly outpace their competitors, taking the company public in 2007 and quietly building this stellar reputation as the go-to guys whenever data centers needed servers fast. Section 3. The first red flags. Because while the engineers were flying, the accounting chaos was just beginning. See, while their production lines were humming along, their accounting department was, frankly, a bit of a mess. It got so bad, it actually led to a temporary Nasdaq delisting back in 2018, simply because they failed to file their financial statements on time. But honestly, that was just the tip of the iceberg. By August 2020, the SEC officially stepped in and charged Supermicro with widespread accounting violations. The government found over $200 million, $200 million, in improperly recognized revenue stretching all the way from 2014 to 2017. The consequences here were pretty severe. The company had to pay a $17.5 million penalty, and CEO Charles Liang personally had to fork over more than $2 million of his own compensation. After paying up, they relisted on the Nasdaq, appeared to have totally cleaned house on paper, and everyone just kind of assumed they had moved on for good. Section 4. AI boom meets accounting doom. An incredible gift wrapped in a curse. Right as they supposedly put all these accounting issues behind them, history handed Supermicro the gift of a lifetime. In 2022, the generative AI boom officially exploded. Tech companies were absolutely desperate for servers to run massive models like ChatGPT, and Supermicro's ultra-fast, highly adaptable servers, they were exactly what the industry was scrambling for. I mean, look at this. At the start of 2023, they had a very respectable market value of $4.4 billion. But by March of 2024, they hit a staggering peak of $67 billion. They were even added to the prestigious S&P 500 that same month. They looked completely 100% unstoppable, just riding the absolute crest of the AI wave. But then, the ghosts of the past came knocking. Remembering those 2018 and 2020 scandals, investors started getting really spooked when a 2024 lawsuit claimed that former employees tied to those old violations had actually been quietly rehired shortly after the SEC settlement. Not a great look. Then, on August 27, 2024, the short seller Hindenburg Research drops a bomb, publishing a scathing report alleging fresh accounting manipulation and export control failures. Literally the very next day, Supermicro announces it can't file its annual report on time. And finally, that catastrophic October 2024 Ernst & Young resignation we talked about at the very beginning. Suddenly, it clicked for investors. They had seen this exact movie before. The stakes of this October 2024 climax were absolutely existential. Ernst & Young wasn't just walking away. They were openly questioning whether Supermicro's board of directors could even act as an independent check on the CEO anymore. The fallout was immense. The Department of Justice opened an investigation. Nasdaq threatened a second delisting in 6 years. You had the $67 billion tech giant suddenly brought to the very brink of total collapse. Section 5. The ultimate business paradox. How do you keep growing in the middle of a disaster? Despite staring right into the abyss, Supermicro actually fought back. They hired a new auditor, BDO USA, in November 2024. And miraculously, by February 2025, they managed to file all their overdue reports without having to restate any of their previous financial results. By January 2026, they had fully regained Nasdaq compliance. But here is the craziest part. While the governance side of the house was running around fighting fires, the engineering and sales side was out there casually breaking records. In the fourth quarter of 2026 alone, they booked over $60 billion in new AI server orders. Full-year revenue hit roughly $34 billion. That is a massive 50% jump year over year. They were growing at such a breakneck pace that they literally had to raise $7 billion in new financing in June 2026 just to keep up with their own massive order book. The AI boom just simply wouldn't let them fail. But right when you think they've finally navigated the storm, bam, we get a massive plot twist. In March 2026, federal prosecutors unseal a shocking indictment. Co-founder Wally Leal, along with 2 others, were criminally charged. The government alleged that they illegally diverted an estimated $2.5 billion worth of servers containing highly restricted NVIDIA AI chips. The feds claimed these were secretly sent to Chinese buyers through Southeast Asian shell companies, which would be a direct violation of U.S. export controls. So, once again, the board was forced to launch yet another independent review into these sweeping allegations. So looking at where they stand as of August 2026, it is the starkest paradox you can possibly imagine. On one hand, you have the business, this booming, unstoppable engineering machine with a $60 billion backlog and 50% revenue growth. But on the other hand, you have the governance, an indicted co-founder, active federal probes, a decade-long history of accounting scandals, and a stock price punished all the way down to around $30. That is less than half of its 2024 peak. It's just this incredible anchor dragging down what should otherwise be a historic, once-in-a-generation success story. Supermicro has proven without a shadow of a doubt that they can build the physical hardware backbone of the AI industry. Their engineering is top tier. But sitting at the absolute center of a technology boom doesn't just magically erase severe corporate governance failures. As they move forward, the uncomfortable question investors are left asking is this: can they ever build the trust to match their hardware?